All right, let's get started. First and foremost, I would like to say welcome. Welcome to JK's Financial Freedom and Real Estate Foundational Training. And so whether you're for the first time encountering JK, Janie, and Kyle, just know US real estate, or if you've been part of the community, part of the events for years and years, this is a training that I love giving because it sets the foundation back into place. And so as we're waiting for everyone to log in and join in if they're on the live here today, but so many people are going to be listening to the recorded version moving forward because this is going to be the very first video and training for new community members who are ultimately going to be joining our online community on Facebook, social media, and etc. So with that being said, welcome. Whether new or old, seasoned or green to real estate and US real estate, we believe to have put something together to really open your eyes to the power of real estate as an investment strategy, an investment, an asset class that really can outperform so many others, especially when you put it on steroids by doing it somewhere where the numbers make even more sense, and in our case, in the US. So let us begin the basics. Investing from a solid foundation. Here we go. I do want to set the stage that this is probably going to be 30, 40-ish minutes. We'll see how involved and how excited I get as we do this training. It's going to be a little longer than our usual deal reveal, but it's going to be full of great content to set that foundation, especially to gain a number sense, to understand the difference between savings and investing, the difference and the power of compound interest, the rule of 72. How much do you need to retire, right? Can you retire with just $10,000? And what are those first steps for you to take to include US real estate into your portfolio, your pre-retirement portfolio, to ultimately accelerate that retirement date for you? So let's begin. So first and foremost, I want to, as I usually do on these little trainings, I give a little disclosure. Everything you see here, if it has to do with legal, go to the legal professional, go to your attorney. If it has to do with accounting, go to your tax professional for that. We're here to show you based on the best of our knowledge and our experience, and I'm sure you're going to love it. So to get started, for those who are really, really brand new, who am I? My name is Kyle Doolan. I got a bunch of letters after my name, and I like to say it just means I went to school for a bit too long. But really, in JK's Real Estate Partners, and when it has to do with US real estate, I'm basically, the monkey in front, doing the dancing, doing a lot of the teaching and the educating, because that's one of my passions. I absolutely love delivering this value to you, and to organize it in a way for someone just starting out to just get it piece by piece by piece and slowly build up their knowledge base and their confidence to take their first moves or their 100th move in perhaps a new market, in a new strategy. So JK's Real Estate Partners is our main baby, if you will, our main company where we teach you how to invest in US real estate. But up to this point, I've got over a dozen other companies all around real estate that Janie and I have built up over the last almost decade now. I became financially free, and we're going to talk about that a little later. By the age of 27, I was still in school, and I became financially free. I graduated from a job, even before basically having a full-time job. And I did this because of US real estate. I did this because I found that there was a hack. I found there was a trick, a hack in US real estate that basically anybody, even a Canadian with no US credit, with no income, could just start building cash flow and start building up their retirement that way. And so we did. And I'm also a collector of Janieisms. Janie comes up with some crazy expressions randomly and naturally, organically, and it's wonderful. One of my favorite is, the world is your muscle. All right, so never forget that. All you have to do is flex to go get those big pipes that you're looking for in your portfolio. Those pipes, those cash flow pipelines. I love it. I just made that up. Next, the other side of the JK coin is the J. We have Janie Grenier, who was formerly trained as a registered nurse with a Bachelor of Science in Nursing and a specialization in Northern Nursing Care. Right? She is the president and CEO of JK's Real Estate Partners and those dozen plus companies and partnerships that we have formed since our tender beginning. Took her a little bit longer to become financially free by the age of 30, but she actually started investing in real estate at the age of 19 in Canada. And it was only after jumping into US real estate that she was able to bring her 1 to 3 Canadian properties to over three digits, over 100 units in just a few years, and ultimately unlock that financial freedom number for her. She is a visionary, a world traveler. She sees an opportunity and then ultimately surrounds herself with people that can help the whole ecosystem achieve their goals. And obviously she's the creator of Janieisms, as I'm sure you understood by now. And another one that's really interesting, watch out when she's in hyperactivity form, because that's where the magic happens. All right. So the more you get to spend some time with JK and Janie, the more these are going to make sense. And we hope you get to that point and ultimately share in the magic that JK has created and continues to create for you. Really, really quickly, I know a lot of you have heard the stories before, but what did our first year in US real estate look like? Really quickly, we dived in deep into education because we wanted to fast track our success. We wanted to learn from other people's mistakes, other people's experiences, other people's success. So ultimately, we wanted to follow a blueprint as much as possible to, not fall into the bear traps and go straight for the results, straight for the jugular. And because of that, we basically were able to retire in 3 years of US real estate investing, whereas some people do this their entire lifetime without achieving that goal. We've spent a lot of money in education, and by the end of spending that education, we didn't have all that much left. And you can imagine, I retired before graduating school, which means when I got started 3 years earlier, I didn't have that much income. I didn't have that much behind me. And what we did have, what I had anyways, was student loans and bursaries and credit cards. And that's all we had left. And we used that to get started. Big warning, it's not for everyone, but it can, and that's our story, so we can't change it. After 1 year, we had acquired 5 properties in the US, a total of 7 cash flowing doors, $2,000 a month of pure cash flow, passive income every month. That's after all expenses, including mortgages. And we had built up about $250,000 in equity because we bought right. And we're going to talk about buying right at the end of our training today to make sure that you're buying right with every single investment you do in the US and in Canada if you continue investing in Canada as well. So this first year wasn't all roses and rainbows. We actually did 2 failed flips. We tried to flip twice in our first year, and it didn't sell for the price we wanted. We ultimately ended up just refinancing and getting the capital back, putting a tenant, and generating our cash flow. One of those 2 properties that we wanted to sell originally is now our top performing short-term rental property in Cleveland, generating over $2,000 by itself of cash flow monthly right now. All right. So it's funny how what you think is the plan at the beginning and what is a good move at the beginning might just be laying the foundations for what is to be an amazing or epic investment in the future. And we're going to talk about the day one versus the future, all the powers of real estate, more than just rental income and having someone else pay for your mortgages. We're going to talk about that as well, because real estate is such a powerful investment vehicle. In our first year, we had the pleasure of meeting, or almost meeting, a ninja raccoon named Jub Jub. Really quickly, we had a contractor who was trying to hide the fact that they were behind, they needed more money, and apparently a raccoon came down the chimney into the HVAC system, into the furnace, and then unscrewed from the inside and chewed up all of the furnace, and then wreaked havoc across the basement with paw prints on the walls, went upstairs and scratched up all the floors that they had just finished buffing and refinishing. So our ninja raccoon named Jub Jub, it will always have a dear place in our heart, because that was the first time that we actually sued a contractor, the first time we won a contractor, and that was just one of the hat trick in our first year, where we brought two contractors and one property manager to court in our first year, and laid again that foundation of where we are today. So we have now built the teams on which we can grow and scale our businesses, but it certainly didn't come just like that. We have put in the sweat equity. So hopefully now you can follow our blueprint and go in there so much easier than even we had it. So that's pretty awesome. Another big takeaway I do want to mention in our first year is, we do have to understand the financing game. We have to get a good grasp of that as we're getting into US real estate. Not everybody is sitting on like $750,000 right now, and that's okay. That's perfectly fine. We certainly didn't when we got started. And we almost put all of our liquidity in one little portfolio that came available to us. It was 2 triplexes and a duplex for $60,000. Now we have to understand that sometimes we have opportunities that are great for one side of the metal, but terrible for the other. What do I mean here? Buying 2 triplexes and a duplex for $60,000 total is very, very cheap. I think we can all agree on that. And they were going to be tenanted and rented when we bought them at that price, which is just phenomenal. The thing is, that would have taken every last dollar we had available, plus our safety nets to buy, and then we would have had absolutely nothing left if something would have happened, or if we wanted to continue buying US real estate, we had nothing left of our own. And at the time, we didn't have the knowledge and the connections and the network to keep on growing without any of our own capital. And so we learned very quickly that financing properties that are worth under $100,000 are harder to finance and more expensive to finance. And so one thing we can tell you right out the gate, right as you're getting started with US real estate, is really have that guideline in place. Do you want to attack properties that are under $100,000? And that could be a single family, that can be a duplex, heck, it can even be a triplex for under $100,000. And those are going to be harder to finance, meaning if you have that kind of capital, you can make some really great cash flow by just putting them in that type of an investment. Or are you looking for properties that are higher than $100,000, which then financing is more readily available, and you can basically just put your down payment, let's say about 33% down on average, let's put some round numbers, 1/3 of the purchase price, expect about that as a down payment, and then a bank or a lending institution will front the other 2/3 for you. And that will allow you maybe to stretch your money a little bit longer to keep the deal flow going and build your experience, so you can ultimately raise capital, gain favor in different partnership opportunities, etc. But I do want to plant that seed about financing and that $100,000 value mark as you're looking to buy with or without financing for these investment properties. The last big takeaway in our first year was that if you do want to do this business remotely, meaning you're in Canada or you're in Australia, you're across the world, heck, even if you're in a different city in the US or in a different state, if you want to do this business remotely, you really need good basics, and that's what we're trying to bring to you, and you need a great team, which ultimately, hopefully you can find readily in our community, or, good luck, and expect that to be one of the bigger challenges of building this remote business if you're developing a brand new market and a brand new team. But these are the big key takeaways of our first year of investing in the US. So let's take one step back and really rebuild that foundation brick by brick. I want to start with the concept of savings, right? That piggy bank, that savings account, like, do we have savings? Is it a good thing? Is it a bad thing? Like, let's just talk a little bit about it. A lot of people say that, it's less risky, that you definitely do need some savings because who knows what life's going to throw at you? Who knows when another COVID might come out? Who knows if you might lose your job? Who knows if your spouse might lose their job? Who knows? Who knows what's going to happen? and general rule of thumb, pretty much everyone will agree that you should have at least 3 months of living expenses readily available in a savings account just in case. And other people will say, no, that's not enough. You really need 6 months or 9 months or 12 months to feel that there's that cushion. So you have time. If there is a hit, you have time to rebuild up without too much stress or too much of a financial hit that maybe you'd have to liquidate other investments just to keep afloat and lose really good investments because you didn't have enough safety buffer in place. Savings account, one of the big advantages of them is that they are liquid, right? Whether that be a tax-free savings account or just a plain old savings account at a bank, the money's there and you can, within a minute, get access to it. It's very, very high liquidity. And typically, why would you need high liquidity? To fulfill short-term spending needs or to seize an opportunity that is just, you're waiting for an opportunity, so it could be in a savings account in the interim. The downside is, well, there's hardly any return, right? There's no, now, rates are going up across the board, and that includes savings accounts and GICs. So now we're in halfway decent rates for savings, but still very, very low compared to the alternative, which we're going to see, which is investing and really using compound interest, having ultimately your money working for you year after year and growing the pool, the capital pool, and really benefiting from capital growth over your lifetime. So with a savings account, you are putting money in your savings account. You are working a job, you are doing something else, and you are putting that money in a savings account. You are working for your money, and it is ultimately considered less risky. There's going to be a little video at the end of the training that you really want to stay until the end for, because it's really funny, and I'm going to address this less risky part, but stay tuned. It's worth the wait. On the other side of that coin is investing, right? Investing, people say it's risky or at the very least higher risk, and that's maybe debatable. If Robert Kiyosaki, he would say it's not the investment that's risky, but the person investing who doesn't have the right knowledge, the right teams, and so forth. So it's the investor that's risky, not the investment. The investment is just, it's just there, and some people are using it very, very well for its intended purpose, and that's great. Investing, I mentioned this, capital growth. The goal is to plant a seed and reap the fruit of the full-grown tree every year, so it keeps on coming, right? You nurture the egg, which ultimately becomes the chicken that lays the egg every day, every other day, and that's the benefit that keeps on coming for many, many years. Ultimately, many investments are less liquid, meaning once they're invested, and it depends on the asset, but once they've been used to purchase something, to acquire something, they're in some sense on the scale, they're locked in some sense. Even in real estate, once you buy a property, the fund is in there unless you sell, unless you refinance, unless you do. And selling and refinancing, well, refinancing, you need to have equity in it to free up any capital, but selling is not something that's done just overnight, right? It can take months to prepare for a sale, to ultimately market for a sale, and to sell. And maybe the first buyer just wastes everybody time and you reset the process. It could take months to sell, and there's no guarantee you'll get the full price you're looking for either. So it is less liquid across the board, generally speaking, when you invest. That's why you want to make sure that where you put your money is worth the fact that you're locking up your liquidity, right? If you're locking up your liquidity and getting a 3 or a 4% return, maybe that's not worth tying up your availability of liquidity, right? Maybe you'd want to put it in a savings account or in a TFSA and search and wait and go get an investment that's an 8, a 10, a 12%, so that the money is there and you can pounce on it to acquire and lock in capital into a much higher investment. And we're going to talk about the difference between a 12% investment and a 4% investment, it is much, much higher than 3 times better. Okay, so we'll just keep that in mind, because we are benefiting from the 8th wonder of the world, which is compound interest. The idea that the money is working for you. You've worked for the money, you put it in an investment, and then from that point, the investment, that money is working for you instead of you working for the money. That's the bottom line. Investing, money works for you. Savings, you work to put money in the savings account. Now, how does this tie into real estate and US real estate? Right before that, I want to ask you a question of, what is financial independence? And there's quite a few people who are on with us live right now. Feel free to write it up in the chat. What is financial independence for you, right? Before I populate the slide here, financial freedom, we often hear financial independence. People are raising their hand. That's wonderful. But really, let's try to get it in the chat, unless you're raising your hand because the chat is not enabled, which I often do. So let's just see if that's the case. And I don't want to delay too long. So just think about it. I'm guessing that's what's happening. I think the chat is disabled. Apologies for the false start here. But think about it. What is financial independence for you? And why do you want it? Why would that be desirable for you? So financial independence, financial freedom, many people have varying definitions and different levels of the term, but generally speaking, it's you hit financial independence when you have enough income to pay for your living expenses for the rest of your life without having a job or being dependent on others. That is financial freedom. You can wake up in the morning, or well, basically get out of bed or not, and the money to cover all your expenses, your gas, your food, your transportation, your car payment, your house payment, everything is covered by your residual income from your investment income, because you're not working for it anymore. Your money's working for you, and the dividends, the return, the passive income, the residual income meets those expenses. All right, so that's what we're talking about. Income earned without having to work your job, just over broke, passive income equivalent to your expenses. And that passive income can come from many, many different sources. It can come from dividend paying stocks. It can. It can come from bonds. It can. It can come from peer-to-peer private lending, and it can come from rental real estate. I'm sure there's no surprise there if you're in the room today. So it can come from many different sources, but I'm here to say that perhaps rental real estate is a little bit better for a couple of reasons. I want to point out that even though a savings account could pay you interest, it could pay you some type of a return, even if that return is in the 3-4%, which was very, very high for an interest, a savings account. Even at just 3 or 4%, it is not powerful enough in 99% of cases to get people to their financial freedom number in one lifetime. And that's kind of the goal here. We have one life to live. Let's make sure we're putting a plan and making moves that'll get us to our retirement with enough money to retire comfortably. So a savings account, although it pays interest, it doesn't pay enough. And we're going to talk about that. The goal is to have a reliable source of monthly cash flow, something that a savings account simply won't do. And so that's why I don't want you to think that you can save your way to financial freedom. Okay, so the goal, a reliable source of monthly cash flow where money is working for you, you're not working for it anymore. That's the goal of financial freedom, financial independence. I want to talk about the rule, the 4% rule. Okay, by show of hands, because I know you can raise your hands now. Who has heard of the 4% rule? Okay, a few hands are coming up. Not that many. I'm thinking less than a 10% of people are raising their hand. So good. I might learn you a little something today. The 4% rule is a rule of thumb that helps people assess really, really quickly how much money they need to retire with normal investments. And typically, like if you go to a financial advisor, they're often going to place you in stocks, bonds, mutual funds, GICs, and so forth, because a lot of people are low tolerant on risk, and for their own reasons. I was going to say good reasons, bad reasons, but for whatever reason, they're often determined as low risk profiles. And so they're put in these type of investments. And so the 4% rule basically states that during the course of your life, you're going to be building a nest egg. And by the end, say at age 65, hopefully, you will have amassed a large enough nest egg, and it will be invested at 4% conservatively, or 4% is the number they use. And so that nest egg, let's say it's $1 million. Well, $1 million invested at 4% is going to kick off $40,000 a year in interest or dividends. And so that's what the 4% rule is used for. If your goal for retirement is to withdraw $40,000 a year, well, you take your $40,000 and you divide it by 4%. And that will reverse engineer it back to $1 million. So it's a way to calculate how big your nest egg needs to be so that you get the retirement income you want. Okay? And the idea is that it's invested at 4, so that 40,000, you're only drawing off the interest and not the principal. The nest egg of $1 million stays there, and you're just living off the interest and the dividends and maintaining the nest egg so that you will never run out. Because if you start drawing off the nest egg, the 40,000 might become 38, might become 36, might become 34, might become 0. And then you have nothing left in your retirement, which is not something we want. It's not a reliable source of monthly income at that point. So 4% is what experts consider to be the safe number to plan a retirement, to have that steady income stream, keeping the principal intact and just living off the interest. 4%. So let's run this one more time. Let's say, and I want you to run your numbers with this example. This is a question, but also an activity. Let's make this interactive, okay? And I'll try to unlock the chat along the way if you want to share. But let's say your retirement income goal was to have $60,000 a year or $5,000 a month, meaning that's $5,000 that's coming in. Money is working for you to get that $5,000. You're not working a job anymore, and it's reliably coming in at $5,000 a month. How much of a nest egg do you need to build up based on the 4% rule? How do you do that calculation? You take that annual retirement income, $60,000, and you divide it by 4%. You divide it by 0.04. So hopefully all of you are going in on your calculator right now and typing it in. And I just realized, Michelle, thank you for writing up in the Q&A section, which clearly is not disabled. If you want to comment in the Q&A section, I will see it, but not everyone else will. So you're very welcome, Michelle. I appreciate those nice words. I think it's a pretty great session too. So what is your retirement number? Take that desired annual income in retirement that you don't have to work for, divided by 4%, that resulting number, like in this example, 1.5 million would be the nest egg that you need to have amassed by retirement so that 4% is drawn in interest equivalent to $60,000 or $5,000 a month. I know it's a lot of numbers, but just do it. Divide what you want to make by 4%, and that number is your target, right? That number, okay. All right, so we have Kim, who just realized that it's a little bit higher than 1.5 million for her, right? And so that number can be very daunting, right? 1.5 million is a lot of money to amass. So how do we get to 1.5 million? I also want to point out that as soon as you amass 1.5 million, you're retired, right? Normally people plan over their life to hit that number by age 65, right? Or by age 55 if they're of the Freedom 55 mentality, right? But the sooner you can get to that number, the sooner you're retired, the sooner you don't have to work a job anymore, because at 4%, you are just fulfilling all your expenses. So that's the first thing. Next, I want to do a little exercise on, okay, but what about if I'm doing real estate? Is it still 1.5 million that I need to amass to get my desired income? So let's listen to this quick video. This is another activity for you to follow. So as we're going through it, go through it, okay? Because I am setting a plan for you right now. I'm giving you the foundations and I'm giving you the targets and the plan for you to reach your financial freedom number. So let's get started. I just want to make sure that my sound is going, but you'll let me know if it doesn't.
What's your financial freedom number? If you're looking to retire through real estate, it would make sense to know how many properties you need to own to retire. And so we're going to do this. It's very, very simple. And first, you're going to have to decide, are you going to be buying your properties without a mortgage? Are you going to be buying them cash with no bank? Or are you going to have mortgages on your properties? And so we call those leveraged or financed properties like that. So are they going to be all cash or are they going to be leveraged? So first step is to figure out how much cash flow, how much residual income do you need to receive every month to retire, to replace your current income. So let's say, for example, you are earning $60,000 a year right now. $60,000 a year is $5,000 a month. If you are buying properties cash with no mortgage, you can expect a little rule of thumb, $500 a month in net cash flow. So if you need $5,000 a month to replace your income, and each property is giving you $500 a month, well, the math is pretty simple. 5,000 divided by 500 is equal to 10. You need 10 properties. 10 properties, that's it, and you're retired. However, if you're going with leveraged properties, I would recommend that you only invest in properties that cash flow a minimum of $100 a month. So you'll notice that the number of properties you need is significantly higher, but they're leveraged in, so you need less money to get into the investment to begin with. So pros and cons. But let's do it again now. How many leveraged or financed properties would you need to retire? So again, you're trying to replace a $5,000 per month income. So 5,000 divided by the monthly cash flow of one property, $100, say, at a minimum. How many properties would you need? 5,000 divided by 100 would be 50. You would need 50 properties with financing, cash flowing at 100 a month to retire. Not impossible. And so that's that. What is your financial freedom number?
Very basic, but very powerful to set that straight. And for the visuals in the room, one more time. If you buy it cash, you need 10 properties cash flowing 500 a month to give 5,000 a month of cash flow, which is 60,000 a year. The next question is, well, I need to buy 10 properties cash. How much will that cost me? Well, in certain markets, Cleveland, Midwest type locations, some of the locations we love for these type of numbers, you can buy $500 of cash flow for about $75,000. And so if you need to buy 10 of them, 75,000 times 10, it takes you $750,000 to buy 10 properties to get the cash flow to retire. Did you notice how this number is lower than the other one? And yet we're making the same residual income. We're retiring in both cases. It just so happened that with this strategy, you needed half the capital to actually retire. Now, Oh, I hope that sank in, because I literally just cut the time to build your nest egg in half, right? Just with basic investments, just because we're in markets where cash flow is much more present and much more predictable. Slashed it in half. So if you planned your retirement, maybe you were a little late, you started planning at 35 and you had till 65. You had 30 years to plan your retirement, and that was 30 years. I just saved 15 years of your life just there, okay? Now, not everyone has 750,000 to invest or has partners with 750,000, although that's a different conversation. Maybe you need the alternative option, which is to buy 50 properties with financing, each cash flowing at least $100 a month. Now, it actually turns out with the math that if you leverage into it, because we don't have 80 or 90% leverages as foreign nationals on investment properties in the US, we typically need to put about a third down. And so if we put a third down of 75, that's 25 per property, times 50, you need 1.25 million. So yeah, it's not half the capital compared to the 4% rule with stocks and bonds at 1.5, but it still is less, even if you finance property. But this just goes to say, for those of you who might be sitting on a valuable property or a lot of equity in Canada, maybe one property has $750,000 of equity in it. I mean, I talk to people all the time who are sitting on properties in Montreal, Ottawa, Toronto, Vancouver, or Calgary and so forth. Like, they're sitting on $500,000 to $1 million of equity. They are literally, and that property is not even cash flowing. That one property is holding in it their retirement, and they are still willing to work another 30 years to ultimately retire, because that investment is holding all that capital, right? It's not liquid yet, but there might be ways to make it liquid and dispatch it into higher cash flow, higher return on investment properties, such as these type right here. So the point here is that we can get to our retirement much faster thanks to real estate compared to many other type of investment vehicles. So very, very powerful stuff. Next, this is just keeping in mind the property's cash flow. That 750,000 that's needed to retire now instead of 1.5 is just factoring in the cash flow of a property. Now, that's great. Cash flow is fantastic, but it's just one of the powers of real estate. There are actually 9 powers that we're not even talking about here that over time are going to help benefit and are going to put these numbers on steroids, get you there even faster. So yes, real estate creates income, can create cash flow if you buy the right way, and it's paid by tenants or even the government in the US by subsidized rent programs like Section 8 or Eden or veterans aid programs, etc. Powerful. As we saw, we could leverage into the investments as well. So we don't need to bring all the cash. There might be benefits to bring all the cash up front and leverage at a later date, but ultimately you don't need all the money to buy all the properties to get started. You can just go one property at a time thanks to loans and banks. Property appreciates over time historically. So what you buy today is on average going to grow 3-4% per year, for the next lifetime. That's not factored into the numbers at all. But you can see how that is another compounding effect that's just working in the background for you. Same thing goes for rents. Rents increase over time. And that's another hedge against inflation. It's another way to increase your cash flow. If you're on top of your market and you see when it's time to increase rents or what the market can support, you're just adding cash flow, and that's just accelerating your retirement date. More than that, on paper, you can depreciate real estate, meaning you can claim a loss, of about 4% per year and not pay taxes on that income and get some tax deductions. So that's even better. That's accelerating once again your retirement date and building your cash flow. On the other side, yes, you can sell properties, but you can also refinance them to further gain leverage. This is not a taxable event. So when you refinance a property, that liquidity is available to redeploy to gain more good investments and more cash flow to ultimately boost your ROI. So even if you don't have 750,000, you can get started and recycle the capital to keep on compounding and stacking your cash flow with the same capital. You can protect it, you can insure it. There's even ways to play with insurance to further benefit yourself in real estate to gain even more cash flow. It's a complicated topic potentially, but these are all things that can all play together, and you have control. You can decide to move an investment from one strategy to another. For example, we've converted some of our long-term real estate into short-term real estate and quadrupled our cash flow, and in some cases even tentupled. I know there's a word for it, decoupled our cash flow, right? And so you can imagine how many properties you need once you have that control, and you can shift and tweak and optimize along the way. That's 8 powers that we haven't even talked about to get to your retirement number. And one of the biggest one is that you can buy at a discount. The 9th and biggest power is that you can buy real estate for cheaper than it's worth with the right negotiations and the right creative strategies to make it a win-win for the seller and for you and everybody involved. But ultimately, you can buy a property for $1 and ultimately now have something that's worth $1.25. For example, you can buy, we bought this property for $65,000 that we bought and renovated for $65,000, and it was worth $107,000 right after we were done the renovation. And so we created $42,000 of equity in this process. That is money that we created, value we created. So rule number 1 of real estate is buy at a discount, buy value. That's just going to accelerate getting to your retirement in time, because you need to build $750,000 of value to retire. That's basically what it means. And so if every time you spend $1, you're making $1.25, you're just accelerating another 25%. So now you don't need 750,000. Now you need 600,000, right? You see what I mean? And with all these tricks all coming into play, you are getting there faster and faster. Second rule of real estate, you need to buy that cash flow, because if you don't have the cash flow, you're not getting closer to your retirement. So those are the 2 rules of real estate, and together, buy low, invest for cash flow is the golden rule of US real estate investing. Now, I've got a fun video here. I don't know how many of you have already seen it. It is worth listening to the end. Can you retire with just $10,000 if you do it the right way and at the right time? Let's see. It's pretty funny too. I think you're going to enjoy. And this is pretty much going to wrap up our evening. There's going to be some action items right after for you to put all this into play and get you started with your first or your next investment property. So this is compound interest at its best. It is the rule of 72 explained. Have fun.
Okay, let's talk about retirement. How much money do you need to retire? Do you even know?
Kyle, should we even know?
What do you mean, should we even know? Do you want to retire?
I'm already retired.
Okay, fine. Do you know how much you need to retire? And I'm not talking about retire at 65 years old, where you're collecting old age pension and you're if you have any RSPs or IRA funds waiting for you. Do you know how much money you would need today to retire? Well, according to literature and actuarial research that's out there, if you are born in the 80s, 70s and 80s, you need $1.8 million to retire today.
What?
If you are born in the 90s, or if you are a millennial, you will need about $2.5 million to retire.
Kyle, that's impossible. It's not like most people put nothing aside. How are they expected to have $2.5 million by the age of 65 to have a comfortable retirement? Tell me.
Indeed. So if you don't already have that money in your account, don't worry. We're here to help. So let's go back to return on investments, interest rates, because that's the key to this whole story. If you have a good job, let's say you have a good job, you're earning $100,000 a year, and you manage to put aside $25,000 of that every year. Okay, you are scraping, you are cutting corners, you're eating craft dinner. You are putting $25,000 a year every year. And let's say you started earning that salary at 20 years old. Well, between 20 and 30, how much money will you have amassed? $25,000 times 10 years, you've earned $250,000. Okay, so you're on the right path, right? That number is going up. Okay. What about between 30 and 40? Another $250,000. Between 40 and 50. Between 50 and 60. So by age 60, you have $1 million. But your retirement is 5 years away, right? Even with a high-paying job, saving $25,000 a year.
That's insane.
It's insane. Who does that? No one can do that.
No.
For 40 years consecutively, that means you'll never have to buy a car, you'll never have to buy a house, you'll never have to change the roof on that house, you'll never have to pay for your kids' education, you'll never have to...
You can't. You just can't.
You just can't. So how in the world can we amass 1.8, 2.5, or if we wanted 10 million, 20 million in one lifetime in order to retire before 65 years old? How do we do that? Interest rates. Okay. So now, rather than just taking your salaried money and putting it, under your mattress every year, putting that $25,000 every year and putting it under a mattress, and
or in a savings account that's literally making you lose money.
Or let's be honest, putting it under the mattress and putting it in the savings account is the same thing, because the savings account is earning you 0.00 nothing ish. Once it's nothing. Okay, so don't even think you're earning something. You're not earning anything. Did you know that there's this quick trick mathematically to see how long it takes an investment to double simply with the interest rate that money is invested at? No? Well, math geek, math guy, here's the trick. It's called the rule of 72. And it's actually quite accurate. I've done the models. Very accurate. It's not just some, it works approximately. It's really quite accurate. And this rule, this is how you do it. You take 72 and you divide it by the interest rate. So, for example, if you have an investment opportunity that's offering you 1%, like a bank savings account, you take 72 and you divide by 1. 72 divided by 1? 72 years to double an investment at that interest rate.
Are you saying, Kyle, that if I'm putting $1,000 aside every year in my savings account, I'm going to be dead by the time I see $2,000 in that same account?
That's exactly right.
That's interesting.
If you put $1,000 today in a bank savings account at 1%, which is better than what they're offering, it will take 72 years for that $1,000 to become $2,000. It's okay. So it's not growing. Okay, it's not. It will not grow.
Oh, and there's inflation.
Oh yeah, right. There's inflation eating away 2% of that. So you're losing. Let's say we go to an aggressive GIC, if such a thing exists, and it's offering you 3%. Okay. Let's take inflation aside, just for the purpose of this calculation. In how many years will that investment double? Rule of 72. 72 divided by 3, which is the interest rate on that investment. 72 divided by 3 is 24 years to double that investment. Let's take it up again. You put $10,000 in a GIC. Let's say you're 20 years old. By the time you're 44, you will have 20,000. Now that 20,000 will double in 24 years. So from 44 to 68, you're now at $40,000. So it had time to double almost by the time you typically retire at 65 years old. Right? Better doubling twice than doubling once. Next level up. Let's say you have an RSP that's earning you 6%. Okay? Medium risk, typical RSP, generally 6%, makes sense. Rule of 72, work it with me. 72 divided by 6 is 12 years to double your investment. Now we're getting interesting. Let's say you're almost said fresh out of the bank, fresh out of school, or at 20 years old, you put $10,000 in RSP. By the time you're 32, you're at 20,000. By the time you're at 44, it doubles, 40,000. By the time you're at, what am I at? 56. I might have messed up my numbers here, but you're at 80,000. Did I do this right? I might be all over the place, but you get it. You have time to double 20 to 65, 3 to 4 times in one lifetime. So at 10,000 becomes 20, becomes 40, becomes 80, baby, becomes $160,000. Much better than your 1% investment that doubled once, but we're not at 1.8 or 2.5 million yet, are we? No. Let's say we have an investment at 12%. Rule of 72. 72 divided by 12 is 6 years. It doubles every 6 years. Now, is that interesting? Well, you tell me. If it doubles every 6 years and you start at 20 and you want to retire at 65, how many 6 years do you have between 20 and 65? That's 45. You have 7 and change. 7 and change doublings until 65. So that means you're doubling 4, 8, 16, 32, 64, 128. Your investment of $10,000 will multiply by 128. Do the numbers. You put in $10,000 once at age 20, and it becomes $1.28 million when you're ready to retire at 65, if you want to retire at 65. One investment of $10,000 with an interest rate that's interesting. So that's why they call it interesting, right? It's interesting, all right? So make sure you're using the right phonetics when you're involved in this topic. So one investment of $10,000 can almost bring you to retirement if you're putting it in the right investment vehicle. That's one decision. That's one $10,000. What if year 2 you put another $10,000 at 12%? Suddenly, you're at $2.5 million for 2 years. That was a good decision on year 20, a good decision on year 21. What if year 3 you put another $10,000? Year 4 you put another $10,000? This is basic stuff. Interest rate. So basically, my point that I'm trying to drive home here is that is an interest rate of 12%, 12 times better than an interest rate at 1%? No. It is so much more. Give it time to grow. Your interest is compounding, and one good decision can set you up for your retirement. I hope this was illuminating. Sun's starting to come down now, so I guess that was a bit of a long-winded explanation, but I'm glad you stick through it. I hope you learned a little something, and I hope you're making your money work for you as hard as you're currently working for your money. What is the best employee you can have? It's an employee that doesn't sleep, that doesn't eat, that doesn't need to go to the bathroom, that never asks for vacations.
What kind of employee is that?
What kind of employee is that? It's the type of employees I have. Janie has. Any good investor has. The best employee is your money. Make your money work for you. And be a bad boss, okay? Just never let them stop working. Put them to work and keep working them. And then that money's going to earn money. They're going to have baby employees. What do you do with those baby employees? Jay?
You put them to
You put them to work. Because guess what? There's no slavery laws on money. Those kind of employees you can use and abuse. We're in a society that this is permitted. And I mean, it's money, right? It's not people. You do it. Do it. All right, that's good enough. So once again, remember, Waminji, we mine now for tomorrow. Happy investing. Talk soon.
And there you have it. I was a wise young little whippersnapper back there. And the point is that where can we get a 12% investment? U.S. real estate, right? US real estate at 12% is not out of reach at all. I would say it is the average return of members of the JK community, of the Now for Tomorrow Club. At 12% is an average return based on the strategies that we teach. And a 15, a 20% might very well be in the works. And this is the day one numbers, not the optimized numbers of year 3 and year 5. So 12%. This example, I think, really hits home the power and the opportunity hidden within US real estate investing for you. And so now to wrap this up, 3 key Now for Tomorrow action items for you to take this information and put it into practice. Step 1, join the weekly deal reveals, right? The link is right on the screen here, n4t.club/free training. Every Thursday, we bring to you a deal that's basically meeting the 12% rule, right? It's very common with a little bit of negotiation, a little bit of JK magic, and you get these 12%, back to back. That's what it's all about. So join the weekly deal reveal. We've been doing this for nearly 3 years, bringing a deal every single Thursday, 7 p.m. Eastern Standard Time, showing you that the deals are there. That's number 1. Join that free training. 2, find your first deal. Okay, that's step 2. In the deal reveal, I show you how to analyze it in under 5 minutes. Okay, get yourself on the path to finding and creating that 12% deal. And if you're unsure because maybe you haven't followed the JK's blueprint or whatever the case may be, you can submit a deal that you're considering to the deal reveal queue of properties, and I will review and analyze your deal live without ever having looked at it before in under 5 minutes to get it on its way to creating your cash flow, the cash flow that you're looking for, and your financial freedom path. All right. I just need the address and the lead source. If you want to give me more, you can. That's all I need. Submit your deal and I will feature it in the queue for the deal reveal. That's the second action item. Third key action, Now for Tomorrow action item, is to read our ebook. We wrote an ebook many years ago, and we've updated recently, JK's Roadmap to Your First Million, okay? We showed you how getting to $1 million suddenly is a lot faster than what you thought, maybe saving your JOB income. We have an ebook for you, n4t.club/ebook. Sign up, get that ebook, and in that, there is an exercise which is to discover your minimum investment criteria to retire on time. Maybe for you, a 12% isn't good enough. Maybe for you, it's a 13.7. So why would you be investing in deals that are below the number that's going to get you there on time based on the amount of capital and resources you have available? Okay, so in the ebook, n4t.club/ebook, you will discover your minimum investment criteria and so much more. And that's really the DIY, right? A DIY method to doing this thing called US real estate. Get that ebook and set that mindset and that foundation for you to take your first investment to the next level. So with that being said, thank you so much for your time. We really filled up the hour nicely, and I'm going to invite you to join us, join US, right? Do Now for Tomorrow for the lifestyle you deserve. And if you need to get in touch with us, our website, nowfortomorrow.club, or our email, info@nowfortomorrow.club, we are there to help. So have yourself an amazing day, evening, and life. We hope to see you very, very soon, and we're excited to celebrate your first or your next US investment property. Have a great one, and we'll see you on the other side.